Welcome back, everybody. Today we are talking about how are investments taxed. Boo, taxes. Nobody likes them, but we have to talk about them because, like it or not, they are going to affect your investment. So without further ado, here we go. Really quick note, let me give my little disclaimer real quick. Tax laws are complex and they can vary from state to country. It is always helpful to consult with a tax advisor or accountant to understand how investment taxes apply to your specific situation, aka your accountants are very smart when it comes to taxes. Consult them. They are the experts. Let's move on. First up, we're going to talk about capital gains because those are generally the more complex types of taxes you deal with. So let's look at those first. What is a capital gain? So a capital gain is when you sell an investment for more than what you paid for it, right? So you buy something, you sell it for more, that is a capital gain. If you do the same thing but you lose money, that is what's referred to as a capital loss. Now, when it comes to capital gains, one of the first things you're going to ask yourself are these gains short-term or long-term? So what the heck does that mean? First, we'll look at short-term. So short-term capital gains are going to be capital gains realized on any investment that you have held for less than 1 year. So 364 days or less, and it is short-term capital gains. How is that going to be taxed? As regular income. So capital gains are going to get special tax treatment, which you'll see in a second. But if it's short-term, they don't get it. It's regular income. Now, after day 365, so 366 onward, we are looking at long-term capital gains, and we're starting to see those tax benefits. So you can see gains taken in that manner could fall into a tax rate of as low as 0%, ranging to as high as 20%, but most average Americans tend to fall in that 15%. But either way, as you can see, generally going to be some tax advantages to doing this, because if you are in that 20%, you probably make a lot of money, and it is probably still an advantage to you. But capital gains long term, we're going to get some capital gains tax advantages there. And another thing to note is that capital gains and capital losses can offset one another. What that means is that if I have gains and I have losses, I can subtract the losses out of the gains and pay taxes on the residual amount. Now, if I have more losses than gains, I can actually even carry those forward with me into tax years. So what is this dude even talking about at this point? We're going to go through an example. Let's have a look. So good old John and Jane are looking to make the following two long-term transactions. So we're talking about long-term capital gains right here. They make them on December 31st. So what I'm going for there is they make them on the same day, aka in the same tax year, at the same time, just for simplicity. One of those trades, they're realizing $5,000 in capital gains, long-term capital gains. In the other trade, they are realizing $3,500 of long-term capital losses. Oof, John and Jane. What we can do is use those $3,500 in losses, subtract that out of the gains we realized in the other transaction, and we're left with $1,500 in capital gains that we are responsible for paying taxes on. Now, presuming a 15% tax rate, because that's probably the most common, but it could be 0 or 20 depending on your situation. But looking at 15% taxes on that scenario right there, we're looking at $225 in taxes owed on those transactions. But let's take a look at if we have extra losses so I can explain a little bit better what I was talking about a couple seconds ago. Two transactions, same day, both long term. One of them $5,000 in gains, exactly like before. This time, XYZ company lost $9,500. Oof, maybe we were using some margin or something. I don't know what happened, but that one got away from us. We can offset those capital gains from the first trade, those $5,000 in capital gains, completely. And the extra $4,500 in capital losses that we have, I can use $3,000 of that. That is the limit in the current tax year. And I can remove that from my income for the year for tax purposes to help me out with taxes that year a little bit. And that extra $1,500 that I can't use, I can carry it forward to next year and either do the same thing, write it off of the income, or use it towards future capital gains. Now that's that for capital gains. Let's take a look at dividends. So we discussed this in our video the other day about dividends, but first we're going to want to know, are they qualified or non-qualified? So if you're not sure, you can go back there and take a look. But qualified dividends are actually going to get capital gains tax treatment, long-term capital gains tax treatment, if they are qualified. So that is a big advantage to qualified dividends that are paid out by public companies on the stock exchange. If they're non-qualified, then they would be ordinary income. But if you're not sure, go back, take a look, and you can watch that video and see what the details on that are. Finally, let's talk about interest. So what you're going to want to know first and foremost is the interest coming from a bank product or a bond? If it's coming from your bank products, things like savings accounts, CDs, corporate bonds, we'll get there in a second, those are all going to be ordinary income. So you will be paying federal taxes as well as any applicable state taxes for your state. Normal income, if it's coming from interest from a bank, corporate bonds, normal income. Now, if that income is coming from a bond, I mentioned corporates are no special treatment, but treasury bonds and municipal bonds will both very likely have at least some sort of tax benefits. So if the interest is coming from bonds, particularly treasuries and municipals, you can probably expect some tax benefits by the way of maybe no federal, maybe no state income taxes, maybe neither, depending on the circumstances. And again, if you want more information on that, feel free to jump back to that video the other day and where we went through that in detail. To wrap us up, I really quickly wanted to mention about tax advantaged accounts, so like retirement accounts, education accounts, things like that. Investments held in those types of accounts are going to be exempt from the treatment we have been talking about here. So if it's in a tax preferred account like an IRA, a 529, any of those accounts that are getting that special tax treatment, you will not pay capital gains nor income tax actively as the investments are earning that money. So if it's happening in those types of accounts, you get a pass. And as always, if you are looking for personalized advice, make sure you consult a financial planner. If you have any questions, please feel free to leave them below. We love questions. If you like this type of content, please like the video. It lets me know that you enjoyed it. Comment on it, subscribe to the channel, and until next time, you guys, that's Finance AF.